Good morning, everyone, and welcome to another episode of Cannabis Unlocked. I'll be your host today, Jordan Euclid with Key Investment Partners. Today, I'm really excited to be joined by the CEO of our latest portfolio company investment, David Kivitz of XS Financial. David, how are you today?
I'm doing great, thanks, and appreciate being back on the podcast.
Yeah, absolutely. I think you're the first guest we've had on multiple times, so thank you so much for joining us here again.
I appreciate it.
Yeah, so last time David was on, we were doing a panel about the need for specialty finance within cannabis. Internally, our firm, Key Investment Partners, certainly continued to believe that that was a very important need for the industry. And so we're really excited to partner with XS Financial in their latest $43.5 million raise. So David, why don't you give the listeners a little bit of an overview of what you guys are doing for your business and what you'll be using the proceeds from this latest investment round to grow your business for?
Sure. So at a very high level, we provide, XS Financial provides CapEx and equipment financing to the cannabis industry. And, one of the ways that we differentiate is we can provide that type of financing at scale. And we always have been doing that. And we've continued to upsize some of our existing commitments that we've made to customers, now approaching 20 million and what per customer. And what this financing really did was give us the ability to not only continue to go out and acquire new customers, but also continue leaning in and expanding the commitments that we've made to our existing customer base who doesn't need 20 million anymore. They need 40, they need 50, they need 100. And, the real focus of our product is partnering with companies and giving them what they need to grow, and specifically within the CapEx and equipment vertical. So, we're supporting a lot of MSOs. They're building out operations in a significant number of markets. And as a result, they have, stout capital needs. And so, we really want to be their partner for this side of the business. And as long as they continue to operate and execute as they have been, we really want to be there for them so that they don't have to go and find other sources of financing, particularly for CapEx and equipment. So, I think in a lot of respects, completing the funding round, which for us was significantly greater than the capital that we had raised to date, I think was really a vote of confidence, not only from Key, but from some of the other participants as well, that not only do we have a good set of customers, but that we can access more and that the needs of those customers will continue to expand.
Yep, absolutely. And how do you think about the evolving landscape for financing in cannabis in the sense of as more legislation passes, as more financial institutions get comfortable working with cannabis businesses, how do you think about the competitive landscape for equipment financing and how you'll be able to retain those critical MSO relationships?
Yeah, at a high level, I think the debt markets, and I'll speak to them more broadly, the debt markets, whether it's senior secured, whether it's an inventory style finance product, a real estate finance product, or what we do, CapEx and equipment finance, I think is getting to be a more robust side of the space. A couple of years ago, that was not the case. It does seem like the better quality companies have access to growth capital now, albeit in the form of different types of debt style transactions. Mm-hmm. So, it's still not robust enough, but it seems like investors and ultimately lenders are coming in to solve for that need. And obviously us being one of them. What I think is really important is one of the things that we focus on, customer experience. Cost of capital is part of that, but it's certainly not exclusively tied to that. And so for us, we really want the companies that we work with to understand we're a partner. What does that mean for our business? It means being cognizant of where the cost of capital is for that business in the industry. So if the cost of capital dynamics shift, be willing to have that conversation proactively with your customer. Don't wait for them to come to you. That's something I think we've done successfully a few times and earns the respect and the trust of your customer, because the market is the market. And, a lot of the customers we're dealing with are big enough where they are speaking to multiple parties and they know what that dynamic looks like. So we want to be proactive about it. Add value outside of just capital. And for us, that means procurement services, how we structure our investments to maximize tax benefits for our customers. Those are just a couple examples of things that need to happen. Now, if you look at the other side of the industry, the equity markets, they've been crushed. And, I think we saw an experience to a high across both public and private businesses back in roughly February, and valuations are off considerably. A lot of companies are showing the preference for the debt capital market because taking equity would be very dilutive right now. And so to a certain extent, that dynamic is playing very much into our strategy. We have capital, we have it to deploy, we have existing customer commitments that we're funding into, and we're also now engaging other customers behind that same conversation. So, I think there is maturation coming in the debt side of the market. The equity markets still have some room to go. And I think a lot of it is being driven, by the lack of regulatory shift in the industry. And so, there was a near-term pop in equity valuations related to, a Republican-sponsored bill. I certainly don't believe it's going to get much traction through the Senate. It seems like the common, talking heads feel the same. And so, I've used the line before, I'll repeat it again. When it comes to legislation at the federal level, I'll take the over because I just don't think it's going anywhere quickly. And unfortunately, this administration has its hands full with what they consider to be bigger priorities. So we're not expecting to see much shift. And so, we are continuing to build the business on that basis. I think other lenders are doing the same. And we've always said, our business is not meant to service the industry for a moment in time where it's federally illegal and state legal. We're building an equipment finance and CapEx finance platform, much like the real estate lenders are building their platforms to participate under any level of federal scrutiny, whether it shifts or it doesn't. So that continues to be the case. And we're excited about the prospects of where we can take things.
Fantastic. That's really exciting. And I think anyone in the industry knows that, demand for capital is certainly not lacking anywhere across the industry. I'd love to get your thoughts as well on the supply side of the equation, right? In terms of obviously operating balance sheet based business, particularly in cannabis, it can be exceptionally difficult to raise the capital that you need to then go out and originate those loans. So would just love to hear a little bit more of your story on how you were able to build the business over the last several years, and then how this new round of financing will really help to accelerate that flywheel of financing.
Sure. So, we have, with the obvious repeat of focusing on the customer first, we spent a period of time right after COVID was announced, taking a very direct and proactive approach to letting companies in this industry know we're here for them. And, if you look at our growth profile, most of it really started in 2020. And if you look even further, it really started kind of from May through the end of the year. And then, of course, really exploded into 2021. And so, I think that was a direct result of us, putting a lot of time and focus on business development, calling companies that were credit quality, but where other lenders pulled back, and, took the opportunity to really let people know that we wanted to help them scale. We believed in their businesses in the industry. And so I think we earned some really good customers through that process and have continued to grow with them. On the back of this financing, it primarily does two things for us. One, we get to go out and execute not only on upsizing our commitments to our existing customers, but as you point out, focusing on attracting new ones. And so the message now is really, using the existing customer base that we have, which in many cases are aspirational customers to the rest of the industry, and explaining why those relationships have worked so well, the problems that we're solving for the customer, and getting that message out there. And in terms of the type of financing we provide, there are not many companies doing what we do. And so whereas, groups are used to being inundated by offers for maybe real estate type lending, they're less, kind of experienced, at least in this industry, with what it is that we provide. And I think we do come to market with some unique ways of addressing some of the challenges in this industry. A great example of that is a lot of traditional leasing companies will start a lease when your equipment is delivered. Well, in this industry, because of some of the capital constraints that you talked about, we actually initiate our leases at the day of order, really the day of signing. And so that customer knows that we're there to pay for that equipment, whether it's been manufactured already, whether it's been delivered already, doesn't matter to us. And so we're going a step further to really solve some of their challenges. And so it's really getting the message out now. It's using some of the customer relationships that we have, leaning into those to help attract new customers, and focusing on earlier stage businesses as well that have started to execute and perform, particularly in some of the limited license markets where now they really need that expansionary capital, and the equity markets have to a certain extent dried up. And so we want to fill that gap for them. And so it's awareness. It's a campaign of really getting in front of the customers, identifying who they are when they're earlier on in their development. And that's been a lot of the effort that we're focusing on right now. And to that point, actually adding another full-time biz dev person who can really go out and canvas the market. So, we joke in the business, we're all on the biz dev team. All of us use our relationships to go and focus on that. And actually, and I'll brag about you guys for a moment, the key team, not only your firm, but a lot of the investors who we brought into this most recent financing were in the industry already, right? Had awareness, have existing investments, whether plant touching or ancillary, and know the industry well. And so why has that been so valuable? Because we've been able to lean into those introductions that you guys have made, relationships that you've brought to the table. And I think it speaks very highly when an investment firm can kind of point to both sides of a potential introduction and say, no, we've done our homework, we've vetted both sides of a potential relationship, and we stand behind both. And so it just brings instant credibility. And so I think, that's why it's in many cases hard for new lenders to come into the industry without any relationships, without any awareness of who's who, because earning that reputation in an industry this small continues to be very valuable.
Absolutely. And I think it's a great point that you emphasize in terms of those relationships and how important it is to have a positive customer experience, because as we know in cannabis, there's a lot of folks who have tried to do things that have fallen completely flat. And so being able to deliver on your commitments is so critical and important for maintaining positive relationships. And I think it's a huge part of the moat that you and your team are building that maybe goes underappreciated by folks less familiar with the ins and outs of the industry.
Yeah, I'd agree with that. One of the things that any growing business, you're constantly seeking, places to deploy capital. In our case, that's obviously new leases. For our customers, that might be an expansionary product. It might be sales and marketing. It might be an acquisition. And you're always toggling kind of how you're capitalizing your business, right? Could be debt, could be equity, could be, some type of a product that falls outside of that, asset-specific financing, whatever it happens to be. And so, for us, we were able to make sizable commitments. We were able to find a way in our early days to make sure they were funded, that being obviously the critical component of the business. And now, with us having a stout balance sheet, liquidity, we are having some very serious conversations with not only customers that are similar to some of the MSOs that we already work with, but also letting some of the SSOs and smaller regional MSOs know that, we're here. I think the cost of capital has also come down to a level where it's an easier decision now, whether or not you want to go and dilute and take equity or consider us as a financing source. And I think that's also something that's resulted from the maturity of the debt side of the market, which is rates are getting to a place where it's starting to be a much more logical decision to take non-dilutive capital. Whereas 2 years ago, a year ago, it was still kind of priced like equity. And it just happened to be enveloped in a debt style product. And so now that has changed, I think it has opened up the market a little bit. And of course, there's still companies that are operating at significant scale that have better access to that type of non-dilutive financing than others. But it starts from the top and it kind of trickles down. And so I think we're seeing a lot more of that now and having much better conversations as a result.
Absolutely. And what are your thoughts on the Safe Banking Act? Number one, do you think it'll get passed sometime in this current presidential administration? And number two, how will that impact your business if it does?
Yeah, it depends what form it takes and ultimately what's included. We've seen obviously a variety of proposals in terms of how to bring better banking access to the industry. In general, I think it's a very good thing for the industry. I think both banks and companies should have the ability to work with one another for a host of reasons, namely safety. And there's no reason to have a significant amount of cash rolling around the industry, not being deposited at banks. Ultimately, I don't think that serves state level legalization, and I don't think it serves, the Fed either, to have this dynamic where there's a question as to whether or not that's the case. Now, I think that's the easy part of the SAFE Act. I think there's, a secondary portion of that, which is capital markets access, lending by traditional, institutions, whether that be banks or others. And so, I think it's going to take some time. Again, speaking to the point I made earlier, I'll take the over. It just seems like getting traction at the federal level on anything related to, the cannabis industry right now is a struggle. It doesn't seem to be a high priority, even though it was obviously part of the agenda that the Democrats, came into power on and was part of the agenda. So that's been very disappointing. In terms of how it may impact our business and or the industry, ultimately it's coming. In what form, whether it's through SAFE, whether it's, through a different process or different legislation, we'll see. My guess at this point is as good as anyone's, because I would have thought it would have happened already, which is why I've become a cynic and now take the over. But in general, I think it's what the industry needs. And as it pertains to my business and Excess Financial, it's probably has some benefits, and it also probably has some negatives to the company. For one, it would broaden our access to bank financing significantly. Yes, we already borrow from a bank, but it's a state chartered bank. We have already hit our borrower limit. And at the end of the day, we are building what in many cases looks like a non-bank bank. Obviously, equipment finance is a banking product that is fairly traditional. There's also a lot of independent equipment finance companies, but in almost all cases, they're borrowing from different types of banks. And so we would hope to see that come into the marketplace quickly. And even prior to safe banking, we're already having conversations with banks and think that we may be able to expand our access. So, we'd certainly like to see that. But I just think generally where the industry is going to go is going to look like every other type of industry. There's going to be certain banks and or financial institutions that look at this space and say, well, it's still a vice product, even though there's kind of a wrapper of health and wellness, and we're not going to touch it, even though we have, legal ability to do so. And then I think there's going to be others that use that as a mandate to jump right in. What I don't think is going to change is if you look at other industries, including non-federally regulated or highly federally regulated industries, banks tend not to lend to small businesses. In many respects, they don't lend to medium-sized businesses. And that's why there's been a large expansion since the Great Recession of merchant cash advance companies and other small business lending entities, because banks have in a lot of respects pulled back in that business line. And so, one, I think getting to underwrite and understand businesses in this industry requires some specialty. So that alone is a reason why I think you're going to see a lot of bank lenders, if and when they do get comfortable vis-a-vis safe or otherwise, use groups like Excess Financial, groups like some of the real estate lenders or senior secured lenders as conduits, because we already have customer relationships. We already know how to underwrite the space. We already know how to think about, the assets that these companies are leveraging. And so, for that reason, I think, that's going to be a benefit to us and to our customers, because if it drives down our borrowing cost, it's going to drive down theirs. But in general, they need the suite of services that banks provide at full scale. And my hope is that happens for the industry sooner than later. My concern is that it won't.
Mm-hmm. Gotcha. And David, earlier you mentioned that you prefer to focus on limited license markets, and I'd love to learn a little bit more about why you think that's the better type of regulatory regime to play in today.
Yeah. So, we've been participating in this industry in some form or fashion since 2017. And, one of the things that we have come to notice is certain markets, and the dynamics are individual to each state. And so, you can't really paint with a broad brushstroke in this industry, but in general, limited license markets have created a framework where you essentially have limited competition, right? Just by definition. And that allows a company to go out and essentially attack the same level of demand at the customer level, but without nearly as much supply coming in around them. And so they've been able to hold pricing. They've been able to and through that process, take their time getting products to market, getting their infrastructure built out. Obviously, they want to race to get out as quickly as possible. But in general, there hasn't been the same price compression as we've seen elsewhere. Mm-hmm. And we've underwritten companies, and I think we're currently active in 18 states. We have active leases in 18 markets across the US. We are a lot more comfortable going to a non-limited license market with the credit quality of, say, a large MSO than we are a standalone single state operator who is solely reliant on the dynamics of that state. Sure. And so, just by default, we've had trouble approving and ultimately financing some California companies. We haven't seen the performance that we would normally want to see coming out of other markets. And so, even though, as an example, that is a very big market in terms of, headline numbers, if you can't operate at scale and profitably, at the end of the day, we're a lender. And so we don't have equity upside. How long somebody's going to have to battle it out in California to ultimately turn a profit doesn't really matter to our underwriting because we're not equity holders. And so that brand development, some of the things that companies are focused on there, is less impactful to how we think about, deploying capital. So for that reason, we have big exposure in Massachusetts and Pennsylvania and Florida and Michigan, and we're looking, at Ohio and Maryland, and certainly we have big exposure in Illinois. And so, doesn't mean that mature markets or non-limited license markets are bad. For example, we are underwriting deals currently in Oregon, and a lot of groups that have actually sustained the price, kind of flux up and down. Mm-hmm. They're still operational, have done very well, and they have good cost control, and they know their customer, and they've proven that, over a significant period of time, certainly for this industry, that, they can operate effectively over a long period of time. And that's a big criteria for us in underwriting, is time in business and the ability to execute. So, yeah. We like Oregon. We've had a harder time in Washington, and Colorado is actually someplace where, we've recently added quite a bit of exposure. So, we're okay with markets where it is a little bit more open, but again, it doesn't necessarily change the underwriting dynamics in terms of how we think. We just, based on what we've seen, there is more margin for error. A company that is operating in a limited license market where they have the right licenses and the right infrastructure, or are targeting build out of the right infrastructure, than there is in companies where it's unbridled competition, a lot of pricing pressure. And, obviously the elephant in the room, right, is dealing with the black market and the gray market. And so, California, for that reason as well, it's a struggle. And, you're competing with, folks that don't pay taxes and don't deal with the same, cost regime that a licensed business does. And so, it's unfortunate, but, we're not going to go and chase that so long as that's the dynamic.
Yep. And do you expect that over time, regulatory regimes in limited license states will shift more towards uncapped markets?
Well, we're starting to see that, right? We're seeing it where round 2, round 3, round 4, there was another large license issuance in Illinois. We've seen Florida expand over time. We're seeing New Jersey expand. So do we think that it's going to evolve? Of course. And I think that's a natural evolution of the market because there is something to be said for competition. In general, we like orderly rollouts and not a free-for-all. So as a good example, we've had trouble financing anyone in Oklahoma. and there's a significant number of licenses, I would argue more than the state needs. And as a result, you're going to fight to the bottom until there's a shakeout. And ultimately, the number of stores that are open reduces and, finds that kind of supply demand stabilization. And so for us, there's just no need to chase that. We have enough business to do in good markets. And if licenses do roll out over time, that's okay. Because, what we've seen is in a lot of these markets where they have capped the number of stores or capped the number of cultivation, they're still undersupplied. And so, where you want to be careful is when the ability for them to way oversupply the market, be it cultivation, be it manufactured goods, be it, retail stores, when that starts to dramatically exceed demand, that's when you get into trouble in any type of business. And so, we do try and keep our eye on that. So, what we like the most obviously is, companies that have broad exposure to multiple markets where we're not solely reliant on the performance of one operation in one state. Because if something were to happen, anything can kind of go wrong from a credit standpoint. Whereas if we have exposure to 5 markets and something happens in one, the other 4 may very well be able to make up for, a bad season or what have you in one market. So diversification is important to our portfolio. It's important how we think about our customer base. And that's also something that we, are obviously looking to see more diversification and expansion of our customers through this most recent financing.
Mm-hmm. Sure. And how do you think about the evolution of the landscape of MSOs over time, right? Do you think that the folks that are the biggest today, Curaleaf, GTI, et cetera, are they all going to win in the long term and kind of all be market leaders, or will we see more consolidation? Will some of them go under? What are your thoughts?
It's a great question. And it's one that I actually had a really good dialogue a couple of weeks ago with one of our attorneys who has a really good perspective on the industry, and he works with a lot of MSOs and on the regulatory front. And, it's interesting in markets where you were early, limited license, and now you're capped. You build out your infrastructure, maybe you're first to market, maybe you're one of the first to market, but then you can't expand. And so it provides this opportunity for others to catch up. And so, do I think that the largest players right now are ultimately going to, be the winners in a couple of years? I think a lot of them will. We're seeing them gobbling up smaller operations where they are allowed to expand, where they're not in markets where they're not capped. Mm-hmm. And so I think that'll continue to be the case. It seems like it's a hard go to be a business that has a couple of stores. So, and only that, or a small vertical integrated business in one state. And so I think you'll continue to see those businesses, sell, exit to some of the larger players. How the larger players start to consolidate, that I think will require a change in the federal dynamic, mm-hmm. because for the same reason I mentioned earlier, a lot of them already have exposure in similar states. And so it's very hard to see combining those businesses when you're capped in a bunch of the markets that they're in. So that makes it challenging for the MSOs to really kind of do that. And so over time, margin, cost of capital, one of the interesting things that's going to come from groups that are seeking debt financing now versus those that did a couple of years ago is they may not be locked into as high a rate over as long a period of time. And so, there might be some advantages not to being first to market, because as the capital markets mature, you may find that you have a reduced borrowing cost. You may find that you're more easily able to access financing. And so as a result, you don't enter into agreements that are, maybe more costly, more restrictive. And so there could be advantages to that. So I think, building out brand is still going to be important. Winning that customer experience is still going to be important. And of course, financial performance. So, high margin profile, operating in states where you can, be successful and make money. That's important. And where you can ultimately expand is also important. So, will they all end up at the table a decade from now? Depends how the industry evolves, and legislation is a big part of that. But as it stands now, it gets harder and harder to see the differentiation because eventually they all start to look somewhat similar
Mhm.
in the markets they're in, absent, a brand partnership or some specific IP that they have. The SKUs look sort of similar. The markets they're in look sort of similar. And the customer experience in many respects looks a little bit similar. And so figuring out that differentiation is going to be paramount to their ability to stand out from the crowd.
Yeah.
And so it'll be interesting to see how they do it. But certainly the groups that are at the top end of that scale right now, the larger companies, they have a huge head start over a lot of other businesses, and in an industry that is capital constrained, that is very valuable.
Absolutely. And I think one of the main concerns around the MSO model today is the concern that once interstate and then international commerce opens up, that you'll see most of the production of supply first shift west of the Mississippi, where you can grow outdoor more cost effectively, and then eventually to countries around the equator like Peru and Ecuador and Colombia, where the cost of labor is much cheaper. And again, the climate's much better for growing quality product outdoors. And so I'm curious, do you share those concerns? Do you think that the time until we get to that point is so long that these MSOs have a lot of embedded barriers from that? Or what are your thoughts on the longer term prospects?
Yeah, I think it really is the latter. I'll take the over. Right? So I think it's going to take a really long time for that to actually occur. I've heard some rumblings about, a couple of states wanting to band together and figure out how to create kind of one market across state lines. Hasn't happened. And it's been talked about for a while. Obviously, you've gathered my thoughts on federal legalization and movement at the federal level on legislation. So, there again, when you start thinking about the international element and just how, I say paranoid or protective the U.S. is surrounding wanting to make sure that we keep, cartel financing out of this industry and that type of money out of the industry. I just think that's going to take a really long time. And that states are going to be protective of their tax base, and their tax base right now looks very good as a result of cannabis legalization coming into the market. And so, it'll be interesting to see how it plays out. I wish I had the crystal ball to tell you how it's all going to shake out. But what I can say is I think it's going to take a while. And so, I think that for the most part, business models are protected for the time being. And I'll tell you what's interesting. And I always get a chuckle out of this, which is, everyone talks about SAFE or other legislation, coming in and the impact that that's going to have on the lending side of the industry. Where I don't think people spend as much time focusing is the impact that that's going to have on the plant touching MSO, SSO side of the industry, right? Because what that's also created is a framework where they can go expand their business with extremely limited competition, right? Because there are no traditional CPG businesses, alcohol businesses, pharma businesses, not in the US at least, fighting for the licenses that they're acquiring, fighting for the market that they're building. And so it's actually been very supportive of, yes, to a certain extent, Access Financial's business and others like us, but it's also been extremely supportive to the MSO and plant touching business model, because it's given them a framework to build absent competition, other than the other companies in their own industry. So, from their perspective, I think it's also bittersweet to see that legislation change. So, I don't think things are going to move quickly. Obviously that's something that I've underlined here. And because of that, those are things that we think about, but I wouldn't say we spend a lot of time day to day focused on.
Sure, that makes sense. So David, you talked about with this new round of financing, you'll look to diversify your customer base. You'll also be looking to increase the facilities with your existing customers as they continue to need further expansion capital. I'm curious, are there any other high priority growth initiatives that you have in the pipeline?
So no, it's for us, it's blocking and tackling. We are also backfilling a little bit of infrastructure in the business. That's something that we are always constantly looking to kind of institutionalize our platform. Obviously, this brought in some significant, traditional financing and from traditional parties. and who I would call institutional. And so for us, it's really revolutionizing the platform. But at the end of the day, our core focus is sign up new customers, focus on the ones that we have, continue to drive down our borrowing cost for the benefit of not only our business, our stakeholders, but also our customers, and continue to find greater access to capital, and really just explain the product and make companies aware that they have more alternatives than I think they realize. And that's really the focus right now. And so, keep doing what we're doing. It's been working for us well. I think there are some little bit further out initiatives. I'll highlight in the press release that we issued regarding the financing. There was a condition that there is a rate drop on the back of a NASDAQ uplisting. That was not an accident. And obviously AFC Gamma and some other lenders have been successful moving to a major exchange. So I think that's something that we have certainly paid attention to, and that we're going to consider giving more time and attention. But in general, in terms of day to day, we're focused on underwriting well, executing in the business, and continuing to build out infrastructure as needed. Although we have essentially a fully built out team to continue executing on our lease strategy. So that's one of the benefits of our business, and we'll continue to lean into that.
Fantastic. Well, David, this has been such a fun conversation. We continue to be so excited to support you and the team at XS, and look forward to continuing to originate a whole bunch of new leases.
Yeah, thank you guys, Jordan and Key, for the support, and as always, being on the podcast. Look forward to being your first 3-time visitor when ready, if we can find a topic that suits. And just wanted to say thank you again.
Fantastic. Thanks so much, David, and have a great rest of the day.
Take care.